you and me come under two types of taxation. See, whatever amount we are earning or whatever amount of money coming to our pocket is being taxed under the two headings. The first one is the income tax and second one is the capital gain tax. So today's topic is about these two taxes, and I will explain both these type of taxes in the most simplified manner, and at the end of the session I will tell you my recommendation that what you should be doing. So first let us understand the sources of income which fall under the income tax category. There are mainly four sources of income. Number one is your primary business income. Number two is the interest which you may be getting from your bank FDs or the corporate FDs. Third one is the rental income which you are getting from your residential property or a commercial property. And fourth one is the dividends which you are getting from your equities and mutual funds. So these four kind of sources are being taxed under the income tax. Let us see what is being taxed under the capital gain tax. Capital gain tax occurs when you are making the gains on sale of capital assets. Now, which are these sources? Number one, when you are selling stocks and diversified equity mutual funds. Number two, when you are selling the debt funds. Number three, when you are selling your properties, either residential, commercial, lands or plots. And the fourth one is when you are making any profits on selling of the gold. So these four kinds of income on selling your assets fall under the head of capital gain tax. Now there are stark differences between these two kind of taxes, and we will first understand about the income tax, how income tax is being taxed. As you know that there are few tax slabs about the income tax. If you are earning less income, then there are few exemptions, and as your income increases you are being taxed at 20%, then 30%. Then there are all kind of cesses like the health cess and educational cess. If your income goes above 50 lakhs, there will be a 10% surcharge. If it goes about 1 crore per annum, the surcharge will be 15%. So ultimately what happens that at the end of the year, income tax department takes about 30 to 35% of your income as a tax, and about 1/3 of your income goes to the income tax department. There are few exemptions also, like in the form of ATC, ATCCD, ATD and ATE. But these exemptions are especially useful in reducing the taxes if you are falling into the lower income group. If you are in the higher income group and earning about 3 to 5 lakh rupees a month, ultimately you end up paying about 1/3 of your income, and there are very few ways you can reduce your taxes. While capital gain tax is altogether a different one. So now let us understand that how capital gain tax occurs. There are few advantages of capital gain tax over the income tax. The first one being, in capital gain tax there are no any tax slabs. There are only a fixed rate. So it doesn't depend whether you are from the lower income group or a higher income group. There are fixed rates for capital gains. The second advantage is that the highest capital gain tax are lower than the highest income tax. Now let us understand one by one. The first one is the equities and mutual funds. Say when you are selling a share or an equity mutual fund, within a year of its purchase, whatever gain you make is being taxed under the heading of short-term capital gain tax, and that is 15%. And if you sell a share or a mutual fund after 1 year, and whatever gain you are making is under long-term capital gain tax, and it is 10%. In both the cases, government charges about 4% cess on this. But here is an advantage, that if your long-term capital gain is 1 lakh, then it is totally tax-free. Only on the gains which you are making over and above the 1 lakh is being taxed at long-term capital gain tax of 10%. So suppose you are making a 2 lakh of profits. First 1 lakh is totally free, and on another 1 lakh you will be taxed 10%. So it will be total 10,000 stack 10,000 rupees of tax on your 2 lakhs of profits, which is merely 5%. Now this is about equities. Second one is real estate. Let us see how real estate is being taxed under the capital gain. When you are selling a property, within 2 years of your purchase, whatever gain you are making is directly added to your tax slab and you are being taxed as per your tax slab. But if you are selling the property and making some gains after the 2 years, then whatever gain you are making comes under the long-term capital gain, and that is 20% after the benefit of indexation. So let us understand this situation by an example. Suppose if you have bought a flat of 1 crore in say year 2020, and after 10 years in 2030, if you are selling this particular flat at the price of 2 crores, so net you are making a profit of 1 crore after 10 years. So by this definition, should you be paying 20 lakhs as a long-term capital gain tax? No. Here comes the advantage of indexation. So let me explain you indexation. If hypothetically we think that during these 10 years from 2020 to 30, if the average inflation has remained 6%, your 1 crore amount, if it compounds at 6 crores, compounded 6% for 10 years, it comes to 1.8 crore. So your indexed acquisition cost will be taken not as 1 crore but 1.8 crore. And you have sold the property at 2 crores. So difference between 2 crores and 1.8 crores comes to 20 lakhs. And you have to pay your long-term capital gain as 20% of 20 lakhs, that is only 4 lakhs. So ultimately what you are paying is net 4% of your 1 crore gain. So this is about real estate. Similarly, in case of debt funds and gold, if you are selling them within 3 years of your purchase, they will be taxed as per your tax slabs. And if you are selling after 3 years, there will be a 20% capital gain after indexation. So this is about the long-term and short-term capital gains about the assets. Now, there is one more advantage of long-term capital gain over the income tax. That income tax is immediate and capital gain tax are deferred. See, what do I mean by deferred taxes? As long as you are not monetizing your capital assets, you are not going to pay any kind of taxes to the government. So let us understand this situation by an example. Suppose you are making an FD of 1 crore in one of the banks, wherein the bank is giving you 6% interest in 1 year. So you are getting 6 lakh of interest on that FD after 1 year. Now these 6 lakhs is being taxed at 30% tax slab if you are falling into that tax slab, and you have to pay 1.8 lakh rupees to the government. Here, whether you are taking that interest out or whether that particular interest is accruing inside the FD, in both the situations you are liable to pay tax. So here the income tax is immediate, while that is not the case with the capital gain tax. What happens in capital gain tax? Suppose if you are making a portfolio of 1 crore today of different stocks, if you are holding that particular portfolio for say about 10 years, say if you are making a profit of 1 crore becomes 5 crores, you are making a profit of 4 crores. But at the end of 10 years, what you will be paying is only 10% capital gain tax. So you are paying only 40 lakhs on those taxes, and those 3.6 crores will be your post-tax money. So what happens here, that while your portfolio companies were multiplying during those 10 years, you didn't pay a single penny of tax to the income tax department. And only at the end of the 10 years, you are paying only 10% long-term capital gain tax. So friends, today we have discussed about the personal income tax and the capital gain tax. And you know that there are multiple advantages of the capital gain tax over the income tax. And my recommendation is that after paying the income tax, whatever amount you are saving as a post-tax income should be converted into different kinds of assets. You hold those assets, let them appreciate for years together, and when you are selling those assets fully in case of real estate, or partially in case of equities and mutual funds in the form of systemic withdrawal plans, you end up paying very less tax. So friends, here we come to the end of our session. Hope it must be very clear about these two kind of taxes. And if you like the video, kindly subscribe to the channel, and I'll be coming with a new topic after a few days. Thank you very much.